Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
We begin this hour with the promise of fiscal stimulus out of China. Equities rallying worldwide ahead of jobless claims in the US and comments from Chairman Powell. Brown of UBS saying recession risk needs to be further priced out. Investors poured money into defensive trades over the last couple of months, but resilient US economic data and a proactive Fed have meaningfully reduced the left tail. We look for Treasury yields to continue bouncing from here and cyclical sectors to outperform defensives. Evan's with us for more. Evan, good morning.
Good morning.
Before we get to the market calls, let's start with the call on the economy. How encouraged are you by what you saw from the Fed last week and what you're seeing from China this week?
Very encouraged. I mean, look, when you have a meaningful change in messaging from two of the most important economic actors in the world, which would be Jay Powell and I guess President Xi and the broader Politburo, it pays to listen. And what we saw from Powell was a message of labor markets fine. We're going to keep it there. We are going to keep it there. And so I think the bar is very low for them to keep doing 50s. You know, ultimately, inflation has come down quite a bit, and that enables them to act more aggressively.
This is something Deutsche Bank said as well. Are you suggesting the next 100 basis points, 150 basis points of easing is actually an easy decision?
I don't know if it's an easy decision. I just think that the next, well, yeah, look, I think the next 100, 125 we're gonna get. The more aggressive that they are right now, the less I think they have to do later. Ultimately, you're as we're saying, we're bringing down recession risk because they're acting sooner and more aggressively at this point.
At a certain point, you have to wonder, how much does this leave inflation as a bigger concern, even if recession is less of a concern? We were talking about that with longer-term yields picking up just a touch. You have to imagine, are we truly seeing just a return to the past normal? Or is this going to be a new inflationary environment where officials aren't willing to allow the economy to collapse enough to create that disinflation?
Yeah, I think we're a long way from inflation becoming a meaningful concern again. I think, we were just talking about oil and what's happening there. And oil is, that's a major disinflationary force, not just on a headline level, but ripples through into core inflation. The labor market is still cooling. You would need to see like a retightening of the labor market, I think, to get like domestically generated inflation getting going again. So I kind of think this is the best of all worlds where they're supporting growth. Maybe inflation becomes more of an issue if we get Trump tariffs and the like down the road. But I think that's, kind of tomorrow's story as opposed to today.
The story that you're painting makes me think the U.S. is less exceptional. And frankly, everything else looks a little more exceptional, especially on the valuations that they're currently trading at. Is that how you're looking at it?
I think the U.S. is still exceptional in one clear way, which is that we have a great productivity story here. We have seen productivity pick up in the U.S. Yes, employment has been coming down, but GDP growth has been really, really strong. And that's allowed us also to get unit labor cost inflation lower. You're not seeing that in Europe. You're still seeing ongoing supply chain issues, corporate margin issues, and the like. You're not seeing that in the UK. And so the U.S. is still quite exceptional on that front. When we talk about the equity markets, though, of course, a lot of that good news, more of it is priced in the U.S. and the rest of the world, as is almost always the case.
You also like China, especially versus Europe. But how much is the European story dependent on what happens next in China and if what's happening with fiscal and monetary stimulus actually works?
Yeah, I think, what happens in China, there's going to be some positive leak through into Europe, especially with some of the big luxury names. If you can shore up consumer confidence in China, then that helps on that front. I still think Europe faces a number of domestic challenges. You still have stubborn wages. You still have German manufacturing sector that is in pretty bad shape. And we had from Mario Draghi last week, or maybe the week before, him talking about how do we get Europe more competitive. And it's almost a sad read because you see such great work, such interesting work of things that can and should be done, but so little confidence that the institutional framework is going to allow politically these reforms to happen.
Well, let me jump in. As an investor looking at Europe, how do you react when the German finance ministry sounds almost unsettled by stock going up?
Yeah, I mean, what
does that tell you about the situation in Europe? Because that's ultimately what's happened in the last 2 weeks.
Look, I think that's the underlying, there's an underlying institutional issues that are going to hold Europe back. Now, I don't think I'm saying anything that's not already reflected in European equities. They're very cheap, and they can receive some bounce from this China improvement, and maybe the ECB gets a little more aggressive, and so that helps. But structurally, it's hard to make this long-term investment case for Europe relative to the U.S.
LVMH right now, you mentioned luxury. LVMH over in Europe up by more than 6% at the moment. So we're seeing that running in luxury, as you might expect. On the menu, a number of asset classes. Let's pick three. So equities, commodities, foreign exchange. Out of those three, to price out recession, what does that mean? To price in what now and where?
Yeah, so I think what we'll see most clear is what's happening in equities regionally and intra-sector. And like I said, a lot of people poured money into defensive sectors here in the U.S. I think we've got to price a lot of that out. I think recession risk, that left tail has been
Well, let's pick a sector. Utilities. Where does it leave you? Given that run-up is actually just off the back of AI as well as the defensive nature of the particular group of stocks as well. What do you do with utilities?
Utilities is the trickiest one because of that AI. I mean, in itself, utilities look extremely overbought. We've seen tons of ETF flows into utilities. It's all telling us, especially given the macro dynamics and our view that yields can bounce from here, that utilities should be vulnerable. But then you get these big AI power demand announcements, and that's so I think among the defensives, utilities look a little bit better. I think in staples, real estate, and healthcare probably underperform utilities. At least you have that AI story there in utilities.
Just listening to you, it seems like overweight small caps, equal weight, overweight Chinese equities, maybe peripherally European securities, underweight bonds, and have a high holiday. Is that basically your view?
Yeah, I think so. I mean, it's kind of like it's like a reflation without the inflation. It's kind of how I'm thinking about it, and that this pricing out of recession risk. But now you have oil coming down for supply reasons, and hopefully that the Middle East doesn't escalate much further from here. But if oil's coming down for supply reasons, that's another very stimulative thing for the private sector and consumers. So I think we have this kind of stimulus from China, stimulus from the Fed, stimulus just more globally, and we're setting up for just this better economic picture than people thought going into year-end and next year.
Always enjoy your work. Just fantastic to catch up. It's been too long as well. Come back soon. Brown of UBS. Let's start with equities. Equities up across the board. Still, that move sticks. Equities up on the S&P, up by 0.8. On the Nasdaq, up by 1.5. Let's flip up the board, switch up the board, turn the page and get to the bond market story. The 2-year yield was lower. The 10-year yield was lower. Now the 2 years just a little bit higher. So that's the change off the back of this in the last 90 seconds. Push that through foreign exchange. Dollar, a little bit stronger. Euro dollar backing off session highs, 111.48. Just remember, payrolls, a week tomorrow. The estimate's 140. I think the survey week was last week. So this is what we're looking at for next month. Payrolls, is it really going to slow down anytime soon, given what we've seen coming out of the jobless claims numbers over the last month or so?
If jobless claims are the best high-frequency indicator, the answer would be no. At the same time, people have pointed to the fact that you're not seeing jobs getting created. It's not just maybe people getting fired, but that people aren't actually getting the opportunities, and you are seeing that in some of the sentiment surveys. However, there is a discrepancy between the bearishness and the fears versus what we're seeing in the claims numbers, and I think that that's what you're feeling in terms of the lift in yields on the margins in the bond market today.
Bryson of Wells Fargo with us now to discuss Jay, I'd just love your thoughts on jobless claims at 218. It just screams there's nothing to see here. Everything's okay. Is everything okay?
Well, so you talk about payrolls coming out,
yep.
Right? And so payrolls is a net number. It's two gross numbers. What we're getting today in the initial jobless claims is people who are losing jobs. What Lisa was just talking about is creating jobs. And so when you look at the economy, we're not creating a lot of jobs. We're not losing a lot of jobs either. And so when you get that net number out next week, we're 135. So there has been a slowdown in job creation. And what that means is you're just not going to have as much income growth going forward as well.
Is it inevitable that layoffs are next?
I don't think it's necessarily inevitable, because if you look at the financial health of most businesses today, that's actually pretty good. Their balance sheets are pretty strong. The debt service ratios for most companies are very, very strong as well. And so they don't necessarily need to lay people off at this point. But, if monetary policy remains restrictive here, that's going to continue to put headwinds on growth, and that eventually potentially could lead to those jobless claims going up.
Do you get the sense that this market is too complacent about this sort of soft landing nirvana, as we've named it, or is this more an economy that's at risk of a reacceleration, that people maybe are a little bit overly complacent about the inflation side of the equation?
So, if you say what's more likely going forward, a slowdown, more of a slowdown from here or more of a reacceleration, I'm going to take the more of a slowdown sort of story right now, just again because monetary policy remains restrictive right here. I just don't see a huge reacceleration right here. And so, when I think about the risk of recession in the next 12 months or so, the underlying run rate is like 15%. If you said to me, what do you think the risk of recession in the next 12 months is? 1 in 3, 30%, 35%? It's not our base case, but we're not out of the woods, right? I mean, you are seeing signs of stress in the household sector. You're seeing delinquencies on credit cards going up. You're seeing delinquencies on auto loans going up. And people's, the excess money they had after, the stimulus programs are all gone at this point. And so you could get a move to the downside here, although I'm not really expecting that.
If that's the case, why shouldn't the Fed go by 50 basis points in November?
I think there's a very good case for that, but I think it's going to be, I think you were saying earlier, it's all, we're just very, very data dependent at this point. And, they're trying to balance the risk out there. And, could you get a reacceleration? Sure, I don't think it's the most likely case, but, that's still that possibility there. And I don't think they want to go 50 to have to reverse that a few months from now.
Well, reverse that because of policy out of Washington in 2025?
So I don't think you're going to get a huge policy shift out of Washington in 2025. I think the biggest thing that Congress has to deal with next year is the extension of the TCJA at the end of the year.
And a debt ceiling.
Are we expecting that right off the bat? Probably not, right? That doesn't expire until the end of the year. Knowing Congress, it's going to take them a long time to do that.
But I guess what about reacceleration of inflation if it came to things like tariffs?
If it comes to things like tariff, you could potentially see that. Now, does that mean the Fed starts to raise rates? I think the Fed, if you were to get a reacceleration in inflation, I think the Fed goes on hold. Everyone's pricing in 200 basis points of rate cuts. That probably goes away. But I think the Fed initially would say wait on hold and see how much it feeds through.
Let's get to Kelsey Berro of JPMorgan Asset Management. Kelsey, good morning to you.
Good morning.
How vulnerable are we to a soft print on payrolls 2 Fridays away?
Well, there's two things to consider. One is how vulnerable are we, and then what is most likely to occur. So the initial jobless claims today suggest that the expansion should continue. The labor market is healthy. Now, if you were to ask me where the balance of risks is, I would say the balance of risks is to the downside. It is to the risk that payrolls growth slows more and the unemployment rate rises. I know there's this debate. If the Fed sees payrolls growth below 100,000, then that's the green light to do another 50. I think we forget that we already had a payrolls print below 100,000 2 months ago. So payrolls growth already is slowing. Now, this is the most new information that I feel like I've learned in the past few days in terms of Fed communication, is that actually, while the market is focused on the debate about 25 versus 50 being primarily about the labor market, some participants are actually opening up the door to additional 50 basis point rate cuts just on inflation alone. And that's why I think, you're not going to necessarily see materially higher yields just because the labor market stays around here. There are other reasons yields should remain low and should be biased lower because of the inflation backdrop alone.
Just to back up, was that Governor Waller that made you start thinking that way?
It was, although to be fair, we've been thinking about it this way for a while, which is that the Fed has justification to cut probably 100 to 150 basis points just on the improvement in inflation alone. And then you couple that with what we're seeing in terms of inflation expectations, inflation break-evens, the commodity complex, the global growth backdrop, and I think they can feel fairly confident that there is space for them to ease, and that's kind of agnostic to, does the labor market stabilize around here or does it continue to move lower?
One of the most controversial aspects of your whole case is that you see this as a reason to buy bonds across the entire yield spectrum. When people come on this show, they have increasingly said, I'm comfortable with it up until about 5 years, and then after that, forget it. Because I have no idea what's going to happen, and potentially we could get even inflation coming back or being stickier because of a proactive Fed. How do you push back against that? Because I'm sure you hear that a lot.
Well, when you think about what we are recommending that clients do here, what we've found when we look at the client base is that despite the fact that the Fed has finally come in after 14 months of being on hold and cut rates 50 basis points, there are still many clients that are under-allocated to fixed income and over-allocated to cash. And so there is still a lot of room to move out in terms of duration. Now, in terms of how I think the term structure of the yield curve is going to evolve, I do think that the curve is biased steeper. So you are going to see front-end yields move lower than long-end yields as the Fed continues to deliver those rate cuts. But I do think that when you're thinking about building a portfolio that has diversification, you can think about a core or core plus fund with a 5 or 6 year duration, which is what you're going to get when you buy one of those full bond funds that invests across the whole maturity spectrum. And that's going to give you both the income and also the benefit of capital appreciation if the claims data is not the real signal, and in fact, the terminal rate for the Fed is not 3, but lower.
In this picture, there's a real question about if you're more biased to the potential for downside risk, why should you go into riskier assets?
So I think there's a couple reasons. First of all of this in terms of the timing and transmission of monetary policy is very uncertain. The lags are very unclear. So we do feel like we're getting closer to reaching an inflection point, but it's not clear which way the economy is going to break. So on one hand, the Fed cuts 50 basis points, and in 12 months, if they succeed in extending the cycle, we could be looking at reacceleration. In that case, spreads should remain very tight here. On the other hand, if this is like every other time in history, then the 50 basis point cut is actually not a proactive move that extends the cycle, but a signal that they're already too late. And to balance those things, I think you need both a combination of duration and high quality, but also some carry in your portfolio, because the outcomes, both tail risks are possible at this moment.
Kelsey, we've got to leave it there. It's always great to catch up. Thank you. Kelsey Berro there of JPMorgan Asset Management.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.